Hello, Uncle Jim here. Today I want to share with you how I sell covered calls, my strategy, go a little bit deeper than usual. And then I also want to share my trades. In the last 2 weeks, I primarily have done covered calls. I think I've done maybe 9 trades, and I think 7 of those were covered calls and 2 were vertical put credit spreads. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, let's go ahead and jump right in. First thing I want to do is to give a market update. This week, and today is January 12th, 2023, and it's been a good week in the market. The market's been up, I believe, every day. Before I started this video, I believe it was even up today. So between last week and this week, it's been 2 good weeks. The market is kind of trended up, and because of that, I've been able to sell a lot of covered calls, and that's what this whole video is about. I want to share more of my strategies with how to sell covered calls, and what I typically like to do, don't like to do. I also wanted to talk a little bit about where I think the market's going. I like to do this in every video, and not much has changed compared to last week's video related to the market. I do think, like I said earlier, that the Fed will start changing their guidance midway through the year. I do think we're going to get another increase later this month, and we'll probably another 0.5%, and then maybe one more after that. But I do think at that point they're going to start changing directions, probably summertime. And when they do change directions, I don't think it's going to be as quickly, meaning they went up really quick. I think going down or lowering the rates, they're going to do it much slower. They may even leave rates the same for a couple of months and then do 0.25% declines versus half a point or 3/4. And I think the market will like that. I do think stocks will be up higher than they started the year, maybe by 7, 8, 10%, something along those lines. We won't really be out of the bear market if you look at the true terms, but we will be having a good market. At least that's my 2 cents, and it may only be worth 2 cents. But I do a lot of my trading related to that. I do think, like I said before, that the market will be higher towards the end of the year than it was in the beginning. Now, cover calls, I've been selling them for a long, long time. At least 12 years ago, I literally can't look at my statements before that, but I know at least 10 years ago, and I believe as many as 12 or 13 years ago, I've been selling covered calls. And I primarily did it in Coca-Cola, and I did not know what I was doing. I just picked a strike price and an expiration and said, well, I want to earn this, and I'm willing to give up Coke at this price. So if Coke was at 60, I'd say I'm willing to give it up at 70, and I would sell a covered call and pick up the premium. Now, for those of you who don't know what a covered call is or what a call is, it's simply there's a market out there. People will pay you for the opportunity to buy stock that you own. Now, in order to sell a call, you need 100 shares, but someone, will pay you money, and they'll pay you more the farther out you go and the closer you are to the actual price of the stock. So let's go through a real quick example. I won't go into a whole lot of detail, but say a Coke is pretty close to 60. So say I want to sell it at 70 in the next 3 months. Well, I can pick an expiration 3 months out, and I could say, well, I'm willing to sell Coke at, it's currently at 60. I'm willing to sell it at 70, and someone will pay me for the opportunity to buy those shares, and I pick up that premium right away. It actually hits my account right away. And like I said, I did that for many years, and I had very few. I don't think I had maybe 1 or 2 assignments during that whole period. But about 3 years ago, I ended up having a lot get assigned. Coke it went up majorly in a short period of time, and I had some get assigned to me. And at that point, I decided I wanted to learn more about options. That there was a lot more to it than I realized. So I started watching videos. I started reading. Finding some books at Barnes and Noble. I never did find any really good books at that time. There may be some now, but I've been able to find what I need through primarily looking at blogs, reading those blogs, looking at videos, and that's kind of how I got started. And I started out slow. I didn't want to jump right into it, so I set my goals low. I started with a goal of $1,000, and I've increased it over the last 2 years. This year, my goal is to earn 4,000. Now, that's not just calls; that's also selling puts. But calls are probably still 50% of my strategy and where I make 50% of the money. And I believe they are the easiest strategy to work with. I don't know. I've been doing them so long, and they seem so simple to do. So I at least think they're this probably the easiest strategy to work with. So when you sell an option, you need 100 shares. I believe I mentioned that a minute ago. Then you need to choose a strike and an expiration. And you can use what's called the option chain, and all brokerages have option chains. So typically they're right off the main position page that you can click on it and link over to the option chain. And that chain just shows you all the strikes and expirations, what the premiums are. And then for Schwab, you actually have to change the view of the chain so that you have what I like to call delta and the Greeks. So you'll have gamma, theta, delta. I primarily just use delta. And easiest way to think about delta is it's almost like a probability or a percentage. So you'll hear or you'll see in my trades, especially if you're in the membership, and I share all my trades, and I actually provide my worksheets every week of what I'm looking at, my favorites, what I'm planning, that kind of information. And I typically include delta both in posting about trades and then also in my worksheets. So delta is that probability, and I typically will do a 20 delta within or for calls. So a 20 delta in my mind is like an 80% probability that it won't, they won't be assigned, or a 20% chance that it would be assigned. And to me, that's been about the right amount of risk for me. I do it differently for puts. I do a lower delta and I take a little less risk. But, again, that probability also relates to the strike price. So if you do a delta, say a 20 delta, and it expires in a month, well, the strike price would be, and we'll use the same example for Coca-Cola. Well, it may be Coke's at 60 and maybe $63. If you go out another month and you do the same delta, well, it would be like $66, and so on and so on. You go out 3 months at maybe $68. So in a sense, that's why sometimes I'll write up to, especially with calls, I'll go farther out. I'd typically like to stay within 90 days, but sometimes I'll go out and do 6 months, 9 months. I've done also what's leaps, and you don't need to know a whole lot of details about leaps other than their option expirations that are more than a year. So sometimes, like, there's expirations in January of 24, January of 25. I believe that June just came out, June of 25. And you can really pick up a lot of premium with those. And, so sometimes I'll do leaps. If I own a lot of shares like Coca-Cola, I will sometimes do leaps to pick up a big amount of change at one time. And I have videos about all those things. And if you take a look at some of my other videos where I go into covered calls, I'll talk about that too. But the important thing to keep in mind is, again, using delta and picking strike prices, especially with calls, is really critical, because if you want to keep the stock and you don't want it assigned away from you, then you want to take less risk. For me, I primarily invest in companies I want to own. Now, sometimes those things change and you don't necessarily want to own the stock anymore, and I'll talk about a few that up here in my trades. I'll talk about some that I'm looking at actually unloading and how I'm going about doing that. But I typically try to invest in companies I want to own. I also want to earn the dividends. So typically I don't want them to be assigned away. So I am picking strikes and expirations where most likely that won't happen. And I haven't had any calls get assigned in over 2 years. Actually, that's not completely true. I did have, I think Microsoft get a call away from me. I did have some early last year, but that was before I kind of knew what I was doing. So that's really important. The strikes and expirations, they're probably the most important thing for you to learn. And then once you've learned that, it's also really important to realize that you don't necessarily have to let them just expire or be assigned to you. You can close them for a profit. So one way I'm looking at potentially making more money this year is picking a profit potential and closing them. Right now, my profit level is like 85%. So I really start considering closing them if they have an 85% profit. And typically what that means is, say you sell the option and you pick up $100 in premium. Well, if you can sell it, or not sell it, actually buy it back to close it, and you can do it for say $15, then that would be like an 85% profit, meaning you got 100 and then you paid 15, so you kept 85 of the 100. So that's one way to think of it. Another thing is if you're in the money, so say you sell an option at 65 for Coca-Cola and Coca-Cola goes up to 66, meaning your strike price is below the price of Coca-Cola. Well, you may, like for me, I don't want to sell it. So what I'll do then is roll it. So I will close that position and open up another position that's farther out and typically at a higher strike price. My goal is to get it out of being what's called in the money, meaning the strike is below the stock price for a call. And again, I try to pick up premium for that, and I'm able to do it most times, and especially for calls. I believe I've been much more successful doing it for calls than puts, and that works out, quite well. So if it gets in the money, you have the potential to roll it. Now, it becomes difficult to roll if you get deep in the money. So say, and this typically doesn't happen if you're buying value companies, they don't shoot through the roof, but growth companies would, and that's why for the most part, other than Apple and Google, I stay away from growth companies, at least with writing calls. If it shoots through the roof and you're 10, 15, $20 in the money, it becomes a lot harder to roll. At that point, you're either stuck with assignment or trying to close it, and at that point, you might actually close it for a loss. And I do, just like I have videos where I actually give you examples for selling calls, I also have examples for how to manage your trades. So you can look at some of those other videos. But the big point here is you can manage these trades for so long, going back a long time. Like I said, almost 12 years ago, I didn't realize that I could close them, that I could roll them, that I could really work these trades a lot more than I did. So I encourage you, to really look at that, determine how you want to manage your trades. I typically look at any positions expiring in 3 weeks and I put those on my planning worksheet, and then I actively manage those as they get closer and closer to expiration. I try to not let anything I don't make any changes on the day of expiration. Usually it's a day or two before or the week before. You don't want to be managing the trade right on expiration, or you could get yourself in trouble. So that being said, let's jump into this next part of the video. But before I do, as always, please subscribe. Please hit that like button. I like to answer all my comments, so add a comment below. I have details about my membership, so you can look at that below too if you want to learn, about my memberships. I have 2 memberships. One includes some coaching. It's a 15-minute coaching session each week. It always goes longer than 15 minutes, but that's okay. I really enjoy talking with people. But I encourage you to take a look. It may be worth your time. It's been growing. I think I may be over 20 patrons now, and I have 4 or 5 coaching. I will increase prices with coaching at some point if I end up having too many people and can't manage it. But currently it's only a couple of people, so it's relatively easy to manage. So let's jump into these trades right here. These are the 4 trades I did this week. I did them literally Monday, Tuesday, Wednesday. I have not done any trades today. I may, after this video, do a trade, but currently I have not. So again, they're all covered calls. The first one was I sold 2 covered calls in FNF. This is Fidelity. It's an insurance company. It's a company I like. And here you'll see I did go farther out. I did go out to June 16th, and I stuck to the delta being fairly close to 20 delta. It may have been a little bit higher than the 20 delta, and I picked up some really good premium, 245. And Fidelity National is one company I do like. It's an aristocrat. It pays a good dividend and increases its dividend, so it's a company I want to continue to hold. So that's why I went farther out. Is I like to pick up more premium and do fewer trades because I really want this to be passive. And these trades I probably spent no more than an hour or an hour and a half making them. A lot of times I just got on, found I have a way of sorting my trades and found what I needed to, and went ahead and initiated the trade. So probably no more than an hour or 2 I spent doing these 4 trades. The next one is WBD. This is This was paired with AT&T. They actually it came from AT&T. I'm trying to think of it's an entertainment company, but it's has not done well. I think it's below, when they spun it off. AT&T spun it off, I think 6 months ago, 9 months ago. I can't remember the exact time frame. It's dropped 50% since they first spun it off. And I don't really want to own it anymore. So it's currently right around 12.50. So this is one of the instances where I'm looking to make some cash on it. I just want to get rid of it. So I sold it a call very close to the money, and I picked up $158. And this is on one contract. The previous one was on two contracts, though. So that's 12.50 stock producing $158 in about 3 months, which isn't bad. But again, if it gets called away from me, I'm perfectly fine with it. I believe currently it's in the money now. I believe it went up above that 12.50. So I'm in a way just trying to get rid of it. So I'm taking more risk because I do want to get rid of this. So it does break my strategy a little bit. But again, sometimes you do find companies you end up owning. This was a spinoff. I've had a few spinoffs, which has been interesting. And this one I definitely do not care about owning at this time. Now, another company that I'm doing the same thing with is Big Lots, and Big Lots has gone through a really rough time. I really have liked them a long time. I've made good money selling options with them, but right now their financials look awful. They're still paying a dividend, but I don't know if that's going to continue. My guess is they're probably going to cut their dividend. So I actually again sold an option pretty close. I believe they're trading around 18, so I sold this covered call expiring on 217 really close to the money and picked up $180 on these two contracts. So this is an example of a company that I did like initially, early last year, not 22, but early 21. I really liked it, and that's changed. And sometimes that happens. So if I end up having it assigned at 20, with what I've sold, it'll be a loss, but it won't be a big loss. And then finally, I rolled Cisco, and Cisco is one of the companies I really like. If you don't have it in your portfolio currently, I encourage you to take a look and really consider it. It pays a good dividend. It's like, I believe, 3.25 currently, the dividend, and they increase the dividend on a yearly basis. It's really turned into a value company, and I don't know if it's an aristocrat yet, but it probably will be at some point. But their financials look good. They're doing well, and it's at $50. It was in the money. So I rolled it out and all these expire or would have expired on January 20th, next Friday. So I rolled it out to April 21st and picked up $167. And I believe it was also it was two contracts. And I'm pretty confident it doesn't move a whole lot. My guess is if it gets in the money, I should be able to roll it up and out again. This is the second or third time I've rolled it, so I've been able to do quite well with it. But again, Cisco is a really good company. If you don't have it in your portfolio, I would seriously consider adding it. And you could sell puts on it too. It's a great candidate for puts. So those are my four trades. They combine for a total of $751. I still have the rest of today and tomorrow. Like I mentioned in my previous video, I'm trying to do $4,000 a month. I believe I'm currently around $1,800 for January. So one more trade. I'm trying to do $1,000 a week. So one more trade, or possibly two, I could be at that $1,000 for this week. But again, I like to do things safely. I don't want to put stocks at risk. And the ones up at the top here that I talked about, Big and WBD. I just want to get rid of them, and so that's why I'm selling the covered call so much closer to the stock price. So that's it. Again, covered calls are the safest strategy. It's a great way to get started. If you already have some securities, that are, say you have over 100 shares, you could definitely, most securities you can sell options on. So that's kind of it. That's what I wanted to share with you today. I hope you enjoyed this. Hope you come back next week. I'm going to talk about cash secured puts and vertical put credit spreads next week. So I hope you have a wonderful day, and thanks again for joining me.